when a man sits alone after the market closes, staring at a ledger that no longer flatters him, that is when the real business of speculation begins. Losses have a way of clearing the room. They silence the noise, strip away bravado, and leave you face to face with your own judgment. I've been there more times than I care to admit, and if you're listening to me now, I suspect you've paid the tuition too. The question isn't whether losses happen. They always do. The question is, can you recover trading losses? And more importantly, can you recover yourself while doing it? Most traders ask the wrong thing first. They ask how to make the money back quickly. They stare at the chart like it owes them something. Have you ever noticed how the market never responds to pleading? It doesn't hear your regret, and it doesn't care about your bills. The tape moves on its own schedule, and your first job after a loss is not recovery of capital, but recovery of clarity. Without that, any attempt to win it back is just another bet dressed up as a plan. I learned early that losses are not accidents. They are messages written in red ink. The chart always told me what it was going to do. I simply chose not to listen. Maybe I traded too large. Maybe I anticipated instead of waited. Maybe I argued with a trend that had no interest in my opinion. Sound familiar? A loss is rarely about the market being tricky. It is almost always about the trader being impatient, proud, or afraid. Now, when a man asks me if losses can be recovered, I tell him yes, but not in the way he thinks. You don't recover by swinging harder. You recover by standing still long enough to see straight again. The market rewards patience far more reliably than bravery. After a drawdown, the most profitable position is often no position at all. Can you sit on your hands when every nerve in your body wants action? Charts don't change their behavior because you've lost money. Support doesn't move out of sympathy. Resistance doesn't soften because you're hurting. Price follows its own logic, and that logic is written in trends, ranges, volume, and time. When you come back after losses, you must read the market like a stranger again. Forget what you think it should do. Ask instead, what is it doing right now? Many traders fail at recovery because they trade their memory instead of the chart. They remember the high watermark of their account and try to trade back to it. That's a dangerous habit. The market only knows the current price. It doesn't know where you were last month. If you anchor yourself to old numbers, every tick against you feels personal. And once trading becomes personal, discipline slips quietly out the back door. I always believe that the market is a great teacher, but it charges full tuition up front. Losses teach position sizing better than any book. A man who has been hurt by trading too big never forgets the lesson, unless greed convinces him he's healed. Recovery starts with smaller size, smaller expectations, and sharper observation. Do you really think you're going to regain confidence by risking more than you can afford to lose? Confidence in trading is not a feeling. It's a byproduct of doing the same right thing over and over. When you reduce size after a loss, you give yourself room to think. You stop watching every tick like it's a verdict on your intelligence. You begin to see patterns again. And patterns are the only honest edge a trader ever has. There's another mistake men make when they're trying to recover. They hunt for the perfect trade, the one that will erase the pain. That trade doesn't exist. The market offers probabilities, not apologies. Recovery is built from a series of ordinary, well-executed decisions. Nothing heroic about it. In fact, if it feels exciting, you're probably doing it wrong. Does that disappoint you a little? The money mindset matters here, but not in the way motivational speakers like to talk about it. Trading wealth is not about positive thinking. It's about emotional neutrality. You must treat a dollar like a tool, not a trophy. When losses shake you, it's often because you've attached meaning to the money that doesn't belong there. The market doesn't measure your worth. It measures your timing. Most men think they are trading money, but they are not. They are trading price. The account balance only keeps score, and like all scorekeepers, it arrives after the game has already been played. When you sit down at the screen and let the size of your account guide your decisions, you've already put yourself at a disadvantage. The market does not see your balance. It does not adjust its movements because you are down 10% or up 20%. Price moves because supply and demand are doing their quiet work, and your job is to read that work without letting your personal arithmetic interfere. I learned this the hard way. Early on, I would look at my losses and feel pressure to make the numbers right again. I wasn't watching price anymore. I was watching my equity curve, and that curve became a tyrant. Every tick felt heavier, because it was weighed against what I thought I deserved to have. Have you noticed how quickly good judgment disappears when you're trying to fix a number instead of read a market? Price is the only truth the market gives freely. Everything else is interpretation layered on top of it. When price is trending higher, it is telling you that buyers are in control, regardless of what your balance looks like. When price is failing at resistance, it is warning you whether or not you need a winner. The market does not negotiate with needs. It responds only to pressure, and pressure shows itself on the chart long before it shows up in your account. A trader who focuses on account balance trades from fear or hope. Fear of losing more, hope of getting it back. Neither has anything to do with price behavior. Price does not care about your fear, and it will not reward your hope. When you shift your attention back to price, something changes inside you. You stop asking how much you can make and start asking what the market is offering. That question alone can save a man years of pain. Think about it this way. Two traders can take the same trade at the same price. One is calm, the other is desperate. The chart doesn't change, but their outcomes often do. Why? Because the desperate man is watching his balance, not the market. He exits early, moves stops, hesitates on entries, or doubles down when he shouldn't. The calm man watches structure, range, and momentum. He lets price decide when he is wrong. Which one do you think survives long enough to learn? Price action is clean when you let it be. Trends form, pause, and resume. Ranges tighten, then expand. Volume speaks before headlines ever do. But the moment you overlay your personal financial situation onto that picture, you distort it. You begin to see things that aren't there and miss things that are. A breakout becomes the one I need. A pullback becomes too risky right now. The chart hasn't changed. You have. I always said that the market is never wrong, but opinions often are. Your account balance is just another opinion if you let it dictate your trades. It tells you how you've done, not what you should do next. The next trade must stand on its own legs. It must be justified by price behavior alone. Ask yourself before every entry, if my account were half this size, would I still take this trade? If the answer is no, then the trade is not based on price. There is a quiet discipline that comes from trading price instead of money. You stop counting profits before they exist. You stop measuring yourself by daily results. You begin to respect the market's timing instead of forcing your own. That discipline doesn't feel exciting. It feels almost dull, but dullness in trading is often a sign that you are doing something right. Are you comfortable with that kind of dullness? When I was at my best, I often didn't know exactly how much I'd made or lost until after the session. I knew whether I'd traded well. I knew whether I'd followed price. The numbers came later. That separation mattered. It kept my decisions clean. It kept me from revenge trading after a loss or celebrating too early after a win. The market doesn't like emotional bookkeeping. Many traders talk about risk management, but few understand that the first risk is psychological. Watching your balance tick by tick is like watching a thermometer while trying to heal a fever. It tells you something, but it doesn't fix the problem. The problem is always in execution, and execution lives in the present moment of price movement, not in the accumulated result of past trades. If you can learn to trade as if your balance were invisible, you give yourself a chance. You begin to see entries where risk is defined, exits where price confirms your read, and moments where staying out is the best position. Your account will reflect that over time, but only if you stop demanding that it lead the way. Price is immediate. It is honest. It tells you when you are early, late, or wrong. Your balance is delayed feedback, often misunderstood, and easily emotionalized. One belongs on your screen during the trade. The other belongs in your records after the market has closed. Mixing the two is like trying to drive while staring at the rearview mirror. The moment a man feels the urge to win it back, he has already stepped onto dangerous ground. That urge doesn't come from the chart. It doesn't come from price, volume, or trend. It comes from inside, from wounded pride and shaken confidence. The market didn't plant it there, the loss did. And once that urge takes hold, it begins to whisper that speed matters more than accuracy, that action is better than patience, that one good trade can fix what several bad ones have broken. Have you ever noticed how convincing that voice can sound when you're hurting? I've learned to fear that feeling more than any market condition. A volatile tape can be navigated. A choppy range can be waited out. But a trader who needs to win it back quickly is trading with a clock that doesn't belong to the market. He is racing against his own discomfort. And the faster he tries to run, the less he sees. The urge to recover losses immediately turns trading into an emotional transaction. You stop asking whether a setup is sound and start asking whether it can pay fast enough. You take trades that are almost right, nearly aligned, close enough to justify the click. The chart hasn't confirmed anything, but your nerves have already decided. At that point, you are no longer speculating, you are negotiating with pain. How often has that ever ended well? Markets move in their own time. They pause, they test, they shake out weak hands before moving in earnest. A trader in a hurry can't tolerate that. He wants resolution now. He wants the market to declare him right quickly so he can breathe again. So he enters early, before the level is proven. Or he sizes too large, hoping to compress time. Both choices come from the same place, impatience fueled by loss. I've always said that big money is made by sitting, not trading. But sitting is the hardest thing to do when you feel behind. Losses create a sense of urgency that the market does not share. That mismatch is deadly. When you feel rushed, you begin to see urgency in the chart where none exists. A minor uptick looks like a breakout. A small pullback feels like the last chance to enter. The tape hasn't changed, but your interpretation has. Winning it back becomes the goal, and once that happens, discipline becomes optional. Stops get wider because you can't afford to be wrong again. Targets get closer because you just want the money back. Risk and reward invert themselves quietly, and by the time you notice, the structure that once protected you is gone. Do you really think the market doesn't notice when you stop respecting risk? The danger isn't just financial. It's psychological. Each forced trade that doesn't work reinforces the feeling of being trapped. Now you're not just down money, you're down confidence. The urge intensifies. You trade more, not better. The market, indifferent as always, keeps moving. And suddenly the original loss looks small compared to the damage done trying to erase it. The market offers opportunity every day, but it never offers urgency. Urgency is something traders manufacture when they stop trusting process. I learned that whenever I felt I must trade, I shouldn't trade at all. The best trades never beg to be taken. They stand out clearly, calmly, waiting for confirmation. If you feel pressure, you are early or you are wrong. One of the hardest lessons in speculation is accepting that time is not your enemy. Impatience is. Losses make men believe they are late, that they've missed something, that they must act now or fall further behind. Behind what? The market has no finish line. There is no prize for speed. There is only survival and consistency. Everything else is noise. When you feel the urge to win it back, you are trading your last trade, not the current one. You are responding to memory, not information. The chart in front of you deserves your full attention, but instead it shares the stage with regret. That divided focus is enough to turn a sound setup into a mistake. Can a man really read the tape clearly while arguing with his past? I've found that the urge itself is a signal, just not a market one. It's a warning light on the trader, telling him to step aside. The moment I recognize that feeling, I learn to stop. Not forever, just long enough for the urgency to pass. The market will still be there. The setup will either form or it won't. But your capital and your judgment don't recover as easily as price moves. There is no trade that fixes everything. Recovery does not come from one bold decision. It comes from restraint, from allowing yourself to be flat, to be wrong, to be quiet. The trader who can do nothing when he feels the most pressure is the trader who lasts. Everyone else eventually trades themselves out of the game. I used to think strength in trading meant aggression. I was wrong. Strength is the ability to wait when every instinct tells you to act. Strength is closing the platform after a loss instead of searching for the next opportunity like a man chasing a debt. Strength is knowing that the market does not owe you recovery on your schedule. The urge to win it back is dangerous because it disguises itself as determination. It feels responsible. It feels necessary. But underneath it is fear. Fear of being wrong, fear of falling behind, fear that the loss means something more than it does. The market doesn't attach meaning to your losses. It only responds to orders. When you trade from fear, your orders carry that fear into the market, and the market reflects it back to you in slippage, whipsaws, and poor timing. If you listen carefully, the chart will tell you when it's time to act. It always does. But it speaks softly, and it never raises its voice to compete with your emotions. When the urge to win it back is loud, the chart becomes easy to ignore. That's why so many men swear the market changed after their loss, when in truth, the only thing that changed was their ability to listen. The market never apologizes, and that is a hard truth for most men to accept. We grow up believing effort should be rewarded and mistakes should be forgiven if we learn from them. The market does neither. It does not care how hard you worked on your analysis, how many hours you watched the chart, or how sincere your intentions were. Price moves, and it leaves no note explaining why it did what it did. Have you ever waited for the market to admit it was wrong, only to realize it never even noticed you? Many traders secretly expect an apology after a loss. Not in words, of course, but in behavior. They expect price to come back to their entry, to give them a second chance, to prove that their idea wasn't foolish. That expectation is subtle, but it shapes decisions. Stops are moved because Oot should turn here. Positions are held because it can't go any further. The trader is no longer reading probability, he is waiting for mercy. But the market is not a moral system. It doesn't punish or reward. It simply reflects the balance of buyers and sellers at each moment. When that balance shifts against you, the market does not pause to soften the blow. It keeps moving. Losses arrive without explanation, without apology, and without concern for how prepared you are to accept them. That indifference is not cruelty. It is neutrality. And neutrality is something a trader must learn to respect. Probabilities are the only language the market speaks. Every setup, no matter how clean it looks, carries uncertainty. A breakout can fail. A trend can reverse. A perfect pattern can dissolve without warning. The trader who understands this does not ask the market to be fair. He asks only whether the odds are acceptable. When you trade probabilities, losses stop feeling personal. They become expected outcomes in a long series, not verdicts on your skill or intelligence. The trouble begins when a trader believes the market owes him something for being right in spirit, if not in outcome. He did the analysis. He followed the rules. Surely the market should at least acknowledge that. But probability does not work that way. You can do everything right and still lose. That is not injustice. That is mathematics playing out over time. Can you accept that without resentment? Resentment is poison in trading. It makes a man argue with price. He starts to think in terms of fairness instead of likelihood. He holds losers because what's not right, that price moved against him. He avoids good trades because the market has been bad to him lately. In both cases, he is reacting emotionally to outcomes instead of objectively to conditions. The market remains unchanged, but his behavior deteriorates. I learned long ago that the market never explains itself. It never justifies its moves. It does not care if you were early or late, bold or cautious. It only reveals itself through price action, and even that revelation is incomplete. You never get the full story. You get fragments, probabilities, hints. The trader's job is not to demand clarity, but to operate effectively within uncertainty. When you accept that the market never apologizes, something important happens. You stop waiting for it to make things right. You take responsibility for risk. You define your loss before you enter. You accept that being wrong is part of the process, not a deviation from it. That acceptance frees you from the need for emotional closure on every trade. You no longer need the market to validate you. This is where many traders stumble. They believe understanding probabilities means predicting outcomes. It does not. It means accepting that outcomes vary. A high probability trade can fail, and a low probability one can succeed. Over time, the edge reveals itself, but never in a neat or comforting way. The market will not line up wins and losses to reassure you. It will scatter them. Can you stay consistent in the middle of that randomness? The market's refusal to apologize is actually one of its greatest gifts. It forces honesty. You cannot negotiate with it. You cannot persuade it. You cannot guilt it into compliance. All you can do is align with it or step aside. That simplicity is brutal, but it is clean. Every mistake belongs to the trader. Every success comes from preparation meeting opportunity, not from favoritism. When a trader expects apologies, he trades with entitlement. When he accepts probabilities, he trades with humility. Humility does not mean lack of confidence. It means understanding your place in the order of things. You are not here to control price. You are here to respond to it. Once that is clear, trading becomes quieter, less dramatic, less emotional. Losses stop being insults. Wins stop being proof of superiority. Both become data points. The trader who survives is the one who treats them that way. He does not celebrate too loudly or mourn too long. He records, reviews, and returns to the chart. The market offers the next probability whether you are ready or not. This is why revenge trading is so destructive. It is an attempt to force an apology from the market. It is a demand for immediate restitution. The trader is saying, "You were wrong, and now you must fix this." The market responds the only way it knows how, by continuing to move according to supply and demand, often making the situation worse. There is no apology coming, no explanation, no reassurance. And once you truly accept that, you stop wasting energy looking for it. You begin to trade what you see, not what you hope will happen to make you feel better. You respect stops because you know the market will not stop for you. You size positions because you know probabilities play out over time, not on command. Confidence in trading does not arrive in a flash, and it does not come from one memorable win. It creeps in quietly, almost unnoticed, built from repetition so ordinary that most traders overlook it. Men like to believe confidence is earned by bold calls and dramatic recoveries, but the market does not reward drama. It rewards correct behavior, repeated faithfully, whether anyone is watching or not. Have you ever noticed how the trades that feel the least exciting are often the ones that do the most good for your account? After a loss, confidence is usually the first thing to disappear. A trader begins to doubt his reads, his timing, even his understanding of the chart. He waits too long, then enters too late. Or he hesitates, then chases. He thinks the solution is a win, any win, just to feel right again. But confidence gained that way is fragile. It rests on outcome, not process, and the next losing trade knocks it over just as quickly. Real confidence comes from knowing you did the right thing, regardless of how the trade ended. That kind of assurance can only be earned through repetition. You follow your rules. You size correctly. You wait for confirmation. You place the stop where it belongs, not where it feels comfortable. You do this once, then again, then again. Over time, the fear quiets because you trust your actions, not the result. Isn't that a different way of thinking about confidence than most people talk about? Big wins are intoxicating, but they are poor teachers. They forgive mistakes. They encourage sloppy habits. A trader can break every rule and still make money once in a while, and that is dangerous. It convinces him that confidence comes from profit, when in truth profit often comes despite bad behavior, not because of good behavior. When the market turns, that false confidence evaporates. Small, well-executed trades do something different. They reinforce discipline. They remind you that you can act without panic and exit without regret. Even a small loss taken exactly as planned strengthens confidence more than a large win taken recklessly. Why? Because it proves you are in control of yourself, even when the market doesn't cooperate. Confidence is not bravado. It is familiarity. A trader who has repeated the same correct process hundreds of times recognizes situations more quickly. He doesn't rush because he knows another setup will come. He doesn't freeze because he has been here before. His confidence is quiet, almost invisible, but it shows in his execution. He enters when the market confirms, not when his emotions demand. Many traders sabotage this process by constantly changing methods. After a loss, they abandon what they were doing and search for something new. New indicators, new strategies, new opinions. They think confidence lies somewhere else, just out of reach. In reality, confidence is built by staying long enough with one approach to understand its strengths and weaknesses. How can you trust yourself if you never stay put long enough to learn? Repetition does not mean mindless trading. It means repeated correct decisions. Sometimes the correct decision is not to trade. That, too, builds confidence. Each time you sit out a bad market, you reinforce the idea that patience is part of your skill set. You begin to trust that you don't need to be involved all the time. The market is generous with opportunities, but only if you survive long enough to take them. A trader chasing confidence through big wins often increases size too quickly. He wants the feeling back, the rush, the proof. That rarely ends well. Size magnifies emotion, and emotion clouds judgment. Confidence built through repetition grows alongside restraint. You trade small enough that mistakes don't define you. You allow yourself to be wrong without being wounded. That freedom is essential. Charts reward consistency. Patterns repeat. Trends behave in recognizable ways. The trader who shows up every day, reads the chart the same way, and executes the same plan begins to feel at home in the market. That sense of familiarity is what most people call confidence, though it looks nothing like excitement. It looks like calm attention. I used to judge my confidence by how I felt before a trade. That was a mistake. Feelings fluctuate. Some days you feel sharp. Some days you don't. The market doesn't care. Confidence should be judged after the trade by how closely you followed your plan. Did you wait for your level? Did you respect your stop? Did you accept the outcome without argument? Those answers matter more than whether the trade made money. Over time, repetition smooths out emotional extremes. Wins don't inflate you as much. Losses don't deflate you as deeply. You begin to see both as part of the same process. That emotional balance is not accidental. It is earned through doing the right thing when it would be easier to do something else. Many traders want confidence before they act. The market demands the opposite. You must act correctly first, then confidence follows. It is built backward from how most men expect it. You don't wait to feel confident to follow your rules. You follow your rules until confidence shows up on its own. The market has a long memory for behavior, even if it has no memory of individuals. A trader who repeatedly respects risk stays in the game. A trader who repeatedly overreaches eventually removes himself. Confidence grows in the space between those two outcomes. It is not loud. It does not announce itself. It simply allows you to trade without second guessing every decision.